My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You know what? I know that people hate me when I just say, stay the course or stay put during a correction, which is what we call a decline of 10 to 20%, like the one we're in the middle of right now, including today where the Dow dipped 7 points. But that was up after it was up 500 points in the morning. Nauseating. The S&P lost 0.54% and the NASDAQ tumbled 1.40%. I mean, it is just miserable over there. Nobody wants to hear stay the course. They want action. Yeah, they want an excuse to sell everything and then circle back at a lower level, the right level. I can't blame them. Who wants to be the bull in the ring? I went to a bullfight once in San Miguel de Allende, Mexico, and it was horrifying. I would have done anything to drag that bull out of that death trap. But it doesn't work that way in stocks. There's the picador phase, where the bull gets jabbed in the head and the neck over and over again to weaken those muscles. And then there's the murder or slaying, whatever euphemism you prefer. I don't want you to get slaughtered like that. I don't want you to be that bull, which is why I keep telling you to own shares in real companies that make real things and generate real profits, perhaps returning them to shareholders with dividends and buybacks. Companies like Nucor, the steel maker, or McCormick, the spice maker, both of which are on the show tonight. It's why I keep recommending that you own Apple, don't trade it. Something that made you feel pretty good, at least for this moment, if you saw the numbers after the bell tonight. It was a tray of superlatives on almost every line, a tech triumph over almost all supply chain issues, sharply better than expected iPhone sales, wearables, and services. The company now has 1.8 billion active devices, and get this, they attract a stunning amount of service revenue, as you can only imagine. Even better, the supply chain situation got better for Apple as the quarter went on. It means that they could continue with this fervent pace this quarter. I think each user is going to be worth thousands of dollars per customer lifetime value as they roll out health and entertainment options that are so popular. Now, these tangible types of companies can feel the sting of the picadors during a correction, but they're all best of breed, so they won't ultimately face the matador, which means they won't be slain. However, if you own the more conceptual names, the formerly huge winners, betting that they'd be the next Tesla or the next Amazon or Apple, these are typically money-losing companies that stocks trade on basis of sales, not earnings, because there are no earnings. Now, some of them do make money, but they've gone out of style at the Wall Street fashion show because they're still revenue growth stories, and I don't know when they're going to come back. When the Federal Reserve decides to hit the brakes on the economy, again, Jay Powell's picador, your head and neck are exposed with these former high flyers because the conceptual stocks simply aren't worth as much as in the tangible stocks versus the tangible stocks in this environment. You know something? It's really a double whammy. The twin matadors of inflation and impending rate hikes. Either one could behead these stocks, but both is overkill. Now, this market's been down for a long time. I use the S&P proprietary oscillator to monitor the selling pressure. I go over it at 10:20 each morning in my morning meeting with Jeff Marks. You got to watch this. This is if you're a member of the club. You can't see it otherwise. And it's going to be stunning when I show it tomorrow and we talk about it. But also, this is of great interest. This is the 10th day in a row where decliners, thank you, S&P, outpaced advancers in the New York Stock Exchange. Do you know that this has been 20 years? There's never been a period, not in 20 years. That's how bad this market really is. And this is what happens when Jay Powell just even talks about raising rates. And it happened, by the way, in late 2018. That said, it's still nowhere near the low readings we saw during the COVID crash in 2020. So you don't really get great comfort. But the October to December 2018 scenario is totally in play now. Back then, Powell wanted to stop inflation, but he overdid it. This time, he's being more considered, but we also have more inflation, and we're much closer to full employment, if not there, if not overshot, which gives the Fed a lot less wiggle room if something goes wrong. Even if Powell's more deliberate this time, he can't turn on a dime and walk everything back like he did after he crushed the market in 2018. In my world, I believe you can ride out the correction with high-quality stocks of tangible companies, like the ones we own for my travel trust, like the ones I'll talk about tomorrow at the 10:20 morning meeting, like Apple. No, we don't know when the picador will stop hectoring us, but there's no sign of the matador on horseback circling in for the kill of the quality names. I want you to think of it as two separate bull rings, one for the tangible stocks and one for the conceptual stocks. There's only one matador, and he's in there with the conceptual bull. These formerly high-flying stocks have already been cut to pieces, and it's an open question, though, whether they can get out of the ring alive. How can the beaten-down conceptual stocks make it? Well, if you think we can fix the supply chain crisis quickly, that causes prices to go up. Remember those problems. If you think we can fix the labor shortage, well, that's wage inflation. There may be a lot less federal assistance this year. And if you think commodities can go quickly from shortage maybe to glut, then this bull gets out alive because Powell will take his foot off the brake. But I don't want to be in the conceptual bull ring. But if you don't see that happening, you should not be betting on these stocks. In fact, you actually might want to bet against them. How do you do it? All right, ladies and gentlemen, let me introduce you to the ultimate hedge. Let me introduce you to the ARK, more specifically, the ARK Innovation ETF, which is run by Cathie Wood, the best money manager of 2020, albeit not 2021 and probably not 2022. Now, Wood owns, this is the ARK, okay? Wood owns a ton of textbook growth names, Tesla, Teladoc, Zoom Video, Roku, Coinbase, Exact Sciences, Unity Software, Spotify, Neil Young, UiPath, Intellia Therapeutics. It's kind of a curious amalgam of animals, pandemic plays, cryptocurrency enablers, medical health breakthrough companies, cost savers, and a streaming music service. Now, most of these aren't like the hundreds of junk companies that came public last year, the IPOs and those torturous SPAC names. Wood's favorites are often profitable. Their stocks have only recently begun to lose you money because their momentum plays that now have lost their momentum. Now, they're not like ServiceNow, NOW, Bill McDermott, growth software company. They reported a terrific number last night because they helped their clients keep costs down at a time of rampant inflation. Stock popped 44 points. However, if you want a diversified portfolio of high-quality, profitable companies that make real things, provide real services, and you don't have the confidence to swap out and swap back in, I don't think you can because that timing's hard, I have a brutal solution for you. The ARK Innovation Fund is listing down 30% for the year. See, this is my ARK Innovation, right? And it had another drubbing today. If you think it's headed further down, the cynical geniuses who prey on investors in the form of ETFs have come up with a way to bet against Cathie Wood herself. It's called the Tuttle Capital Short Innovation ETF. Its symbol is SARK, S-A-R-K, and it literally shorts whatever Cathie goes along. It's frankly too cruel even for me. But, man, I want to think of the SARK ETF as the scotch that happened to be my parents' choice. SARK, as in Cuddy Sark. Yep, you can buy some SARK and hedge your position. If you're worried this correction will continue, then stay the course in the stocks that are holding up, and then you use this thing to bet against the growth stocks that are the center of the blast radius. The ARK! Now, I don't want this to turn to some kind of like claymation death match like we saw a year ago today with GameStop, where the longs literally set out to crush a bunch of short-selling hedge funds. When you're picking stocks, please don't make it personal. That said, I need you to remember that what's going on here now, the Fed could be tougher than expected. Jay is not trying to bring down the ARK. He's not trying to sink it. It's simply collateral damage from his fight to get inflation under control. I've been in this business for 40 years, and I can tell you that these growth stocks are the ones that get hit hardest in a tightening cycle. So here's the bottom line. Now you know how to bet with Powell if you think that Jay Powell wants to destroy the economy. You pour the SARK over the ARK, and you bet that they all drown, and no one gets out alive. Let's take some calls. John in Pennsylvania. John.
How you doing, Mr. Cramer?
Couldn't be better, man. I feel like I had a few. What's happening?
I've been sitting home for 3 weeks getting over a hip replacement I had done. First thing I did was join the CNBC Investing Club.
Yes! Yes!
And I understand there's a new world we're living in here with investing.
Well, we try to make that 10-20 meeting. I mean, I got CEOs watching the meeting. It's just a lot of fun. What's going on?
Yeah. So my question to you is, in this new world, every day, Yeti is getting beat down. It's getting down there. Where does it fit in the new world?
Well, I got to tell you, it's very interesting you said that, because Yeti was recommended yesterday by someone, and it was the most beautiful recommendation. So many good things happening there. It's a really interesting idea. I think that Yeti may be the kind of stock that you can ride things out with. But remember, we want dividend, we want return of capital, and we want things they do make things. All right, now, I mean, hey, if you think the Fed wants to destroy the economy, now you know what to do. You pour the SARK over the arc. And you bet that the whole thing stinks? No, sinks. On Mad Money tonight, could McCormick add a dash of spice to your portfolio? I'm checking in with the CEO. Then we have had an influx of new deals hitting the market, but which are rightfully being punished and which could be worth watching? I'm digging into the latest inventory in the street. And Newport jumped 4% today after putting a better than expected quarter. I'm digging into the numbers with the company's top brass. So of course, stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.